Good morning to all. It's glad to be here once again, and thanks to the team from The Economist for organizing such a timely event. Daniel, Joan, Katerina, all of you, good job. Two issues on my agenda. One, I want to talk about the progress in the reduction of NPEs, the yoke around the neck of Greek banks. And second, and more optimistically, talking about the role and the prospects of bank lending, and more importantly, the role rather than the prospects. So let's begin with the asset quality. Legacy NPEs, after the announced securitizations using the Hercules law, will be around 12 billion euros, a ratio of around 8%, and that will be in mid-2022, if they're all successful, and I presume they will be. That ratio is inflated by the very low denominator. Loans to GDP in Greece are only 60%. Now, this amount of NPEs, which is small in a nominal amount, has over 50% cash coverage of provisions, and there's a significant amount of restructured loans which are in their 12-month EBA-defined curing period. So we're near the end. Not there, but very close. There was fear that COVID would create a new wave of NPEs. That seems not to be the case. Approximately 20 billion of loans entered into installment moratoria, which mostly expired at the end of 2020. And we have great results after 6 months. And our current estimates after the announcements of the Q1 results from the 4 systemic banks is around 20% of banks of these loans will have payment difficulties. If you do the arithmetic, that's around 4 billion. Combined with the curing, the imminent curing that I mentioned, this does not seem to pose a problem for the bank's balance sheet or their capital ratios. So I think it's safe to say that any uncertainty around the bank's capital position has receded, if not disappeared. That brings me to my second point. And here we see that loans are, as I said before, a relatively small part of Greece's economy. As a percentage of per capita income, they are far below Portugal's, which has a similar per capita income. Loans to GDP in Portugal, about 110%. So the question is, why is loan penetration so low? And how loan growth can best be used to finance sustainable growth? Part of the answer we already mentioned was a disintermediation due to the economic crisis. Another part of the answer was mentioned by Minister Staikouras. It's the low amount of capital investment during the crisis. Even now, gross fixed investment is only 11% of GDP. That's near the replacement rate, near the rate of depreciation. To have sustainable growth, we need to nearly double that. The math there comes out to around 15 billion per year additional investment on average increase over the next 5 years. We're a bank-based economy, so the banks will have to play a major role in providing that financing. It is not just to hand out the money, but also to guide it to the most productive investment. So there's an additional, in my view, even more important role. And that includes the funds related to the RRF. We also need to try to advise our smaller, less experienced clients in the use of such funds. Now, there is a question and raised by Klaus Regling, about how banks can fund the economy. It is not so much the lack of liquidity. There are structural issues. And for me, the most important part is the size of firms. Let me give you some color. We have about 900,000 firms in Greece. 95% are very small, with average employment of 2. They generate 30% of the sales, but they're clearly less productive than the other larger firms. In addition, 60,000 firms declare income greater than 10,000 euros. Of the personal enterprises, only 100,000 declare income over 10,000 euros. That's very hard for a bank to provide loans on that type of profitability. So this explains why small firms are underrepresented in lending. They only have, in terms of performing loans, they're only about 10 billion, and that's only about 15% of total corporate loans outstanding. Now, this year, loan growth with support of government programs, government guaranteed programs, co-financing programs, was almost in high single digits. The government's returnable tax advance program also supported programs. It also provided a substitute for bank financing for non-bankable firms. But larger firms are clearly more productive, and the ancillary question is how we can get smaller firms to become larger firms. And here banks can help, they can advise. We can provide them also with smarter credit approvals. We're using big data to be able to judge creditworthiness, and that's going to help us for firms that don't have financial data. But policy also needs to play a role. Clearly, as I think Mr. Minister mentioned, rules of the game, paying taxes, will definitely be there. The government's pushing digital transactions is also very important. The more that we use banks rather than cash will help. But there needs to be a carrot, and here we can provide incentives to become larger by providing limits to who can use RF funds, who can use government guarantee programs. There has to be a carrot and a stick approach. And in general, there has to be incentives to make firms larger, more bankable, and therefore more productive, more efficient, and more competitive. To conclude, Greece is at a very rare economic conjuncture. We've seen it, I think, twice in my memory in the past 40 years, the fall of the junta and the entry into EMU. The stars are aligned. We have great opportunities. We need to use the RRFs wisely. We also need to do the structural changes to make the economy more competitive.